and welcome to the CoinInvest Market Insight series.
And today we are going to share with you the Federal Reserve and interest rates, which is the continuous series from the previous video that we have did not long ago.
It was last week.
Yeah.
A quick introduction of myself. I've been in the healthcare industry for the last 28 years in pharmaceutical and medical devices, and doing investments for stocks and ETF for the last 20 years or so. A couple of years back, we started with options and futures, and I started teaching the investments with Jeremy for the last few years now.
All right. And yes, for me, myself, Jeremy here, I've been investing for more than 10 years. I'm in hedge fund administration and compliance, and that is where I can share a lot of my experience in the stock market. And yeah, that's all.
So a quick disclaimer here is that whatever we will be sharing here today will be our personal capacity. They are not at all any form of recommendations. They are only for your education and entertainment purposes. Please do your due diligence, and of course, past performances does not guarantee any future outcomes. So material here will be on copyright. Please do not circulate, copy, or duplicate them.
Okay, so with regards to today's topic on Fed Reserve and interest rates, there are 6 topics that we can talk about, which is the US Federal Reserve, how the US Federal Reserve actually controls the money, and how Fed rate changes through the history, and how rising interest rate affect us, and the US federal revenue versus spending, and definitely what can we take a look in 2021 onwards in the US economy itself.
So as you know, Federal Reserve, of course, now is run by the chairman, Jerome Powell. And in the last video, we have shared that whatever the announcements and the news coming out from the Federal Reserve as well as the FOMC is very important. All the bull and all the bears players will be hearing very attentively on what announcements they will be coming out. And of course, today we'll be sharing how interest rates would affect the markets.
All right, and we also touch upon the Federal Reserve systems, right? There are 3 key entities, which is the Federal Reserve Board of Governors, the 12 Federal Reserve Banks, and as well as the FOMC, right? The Federal Open Market Committee. And there are 5 key functions, right? One of them, which is conducting the nation's monetary policy, helping maintain the stability of the financial system, to supervise and regulate the financial institutions, to foster payment and settlement system safely and efficiently, and last of all, which is the promoting the consumer protection and community development.
So with that, we want to see how the Fed actually controls the money supply and driving activities and businesses and economy within the US. So the Fed, through the FOMC, will regulate the market through monetary policy, and that is through the Federal Open Market Committee, the FOMC, through open market operations. And the tools that they use are, of course, using bonds, looking at how they will adjust the interest rates, moving reserves, as well as increasing loans to drive the economy. So these are the policies and the tools utilized by the Fed. So for example, during recession, Federal will want to increase and expand the market. And the tools that they use would be, of course, one of the things most commonly used is to reduce the interest rates. By reducing interest rates, it will drive more activities and increasing the purchase of bonds, for example. And with the money that they receive in the banks through the sale of the bonds, they will increase more loan with a low interest rate to drive more loan mortgages, and that will increase the consumer spending and business investment. And hopefully that will shift the economy to be improved. During the inflation, of course, the opposite would happen. The Federal will want to see how they can contract the market, and opposite will be increasing the interest rates. And by doing that, consumer spending as well as the business may slow down and also be stabilized. And the shift would be to reduce the GDP, the price level.
Yeah. So again, how does it affect us, right? A low interest rate environment makes borrowing more attractive, right? Because why? It's now less expensive to borrow money, and because of the low rates on their credit products, right? And when the interest rate increases, actually the savers reap the benefits by putting more money in the bank to earn more interest. So you maybe when you look at the interest rate announced by the FOMC, and then you can see how you can take advantage of it from the rising and falling rates to maximize your financial benefits when it comes to borrowing, saving, and spending priorities.
So in 1 year, there will be about 8 FOMC meetings, and they are having it on a very fixed dates on a particular month. And if you want to know on what months they are having the FOMC meetings, you can actually Google it, or you can watch our previous video for that. So looking at this interesting chart is a 200 years chart on the 10-year treasury yield, which is the bond, and how the interest rate would interact with it. And you can see there is a very tight correlation between the interest rate, which is these bars over here, and the blue line over here is representing the 10-year treasury yield, which is the bond. So you can see that there was a surge here sometime during the 1950s up to the peak of 15.8% in terms of the treasury yield. And that's very, very good returns that you are going to get. And since then, over the last 40 years, there is a drop in the treasury yield as well as in the interest rate. So you can see that there is a tight correlation between the yield, interest rate, and of course the bond. How does that affect the stocks then? And if you look focus on the last 30 years here, as the market goes up using the monetary policy, the Federal would also want to drive the economy over there by driving the economy. At the same time, when it is on the high side, they will be using the monetary tools to stabilize the economy. So you can see that in actual fact, there is there's a tight correlation there. But overall, if you look at the 30 years, the last 30 years, the overall increase in the stock market in particular, you can see that there is a drop actually over the same period in terms of interest rate. So there is an inverse correlation between stock growth and interest rate. And therefore, when we refer to the previous slide, you will also notice that the bond and the stock are always inversely correlated. So that's the relationship between stock, bond, and interest rates.
All right. And in terms of interest rate in response to the economy, what does the FOMC do, right? What does the Fed do, during market crises, or, especially we witnessed the 2020 pandemic, right, with COVID. But before that, let's go all the way back to 2005, where we can see that Bush is re-elected, and you see there's a steady growth in the interest rate itself because the economy was doing well. But then what happened, right? That is where the 2007-2008 crisis, right, where the financial crisis really hit hard, and you can see that there's a sudden, big dip on the interest rate. Why is that so? Because this is where you can see that the FOMC actually did planned meetings and unplanned meetings, right, over here to actually find out what is the best method to improve the economy. And that is where reducing the interest rate can help the companies, right, to continue to sustain themselves. Okay, so all those in circle in pink color, as you can see, they are all planned meetings, right? And those that are in green color are unplanned meetings. So you can see that the unplanned meetings are normally held during financial crisis, right? So let's take a look at the other side, which is the 2020 as well, where the pandemic hit in February 2020, and that is where the unplanned meeting came in again with a significant drop in interest rate, 50% to even now almost 100% kind of interest rate now in response to COVID-19. And this is very important because with the low interest rate, right, the companies can borrow more money to sustain themselves and to continue with their operations, right? So this is also very important because with lower interest rate, companies can continue to employ their staffs, right? And that is where in order to prevent a recession, right, is to actually sustain the employment, right? And that will be explained more in the next few slides, right?
So again, you will see here the spending versus the revenue. Overall, in the last 55 years, starting from 1965, the spending, which is the red line over here, has been consistently higher than the revenue. On average, you can see that spending rate is about almost 20%, while the revenue has been about almost touching 18% only. So the federal government has been spending more than revenue. And you can see that, of course, during those recession period, the stimulus comes in, and that's where the spending goes up. So they do really have a spending problem.
And you can see, according to this deficit enhanced during this crisis, even in 2018, what happened was that what does it mean by deficit? It means that spending is more than revenue. When you take spending minus revenue, right, that is a deficit. When revenue is more than spending, then that will be what? Profits, right? So that's where we want to see, based on 1950s until now. And let's take a look at, just straight away point out to the before the dot-com boom over there, which is 2000. You can see that there is a significant drop from 1989, 1992 to about 2000. And that is because the economy was doing well, right? The economy was doing well until the dot-com bubble crisis happened. The bubble exploded, and that is where the stimulus come in, and the government spending increased again, and back up all the way, to even now with 2007, 2008, the 0809 crisis, the Lehman Brothers over there, that causes a big chain effect of the whole financial system over there. And that is where the Great Recession was actually happened. And again, stimulus was being input into the economy so that they can continue to sustain it. So you can see, what the Fed has been doing in terms of spending and getting back money from the economy itself.
So with that in mind, what is the expectation for the next decade, 2021, next year onwards, which is just about 2 months away from now? And of course, you are expecting that the pandemic is not going to go away tomorrow. It will be a sustained problem, which is a global problem. So with that, you can see healthcare costs will continue to be more expensive. It has been increasing for the last 30, 40 years, and it will continue to do that. And we all know with the climate changes, more expenditures, more money is actually pumped in to regulate, better climate control. You can see federal debt will continue to rise. Already we saw the deficits are there for the last 55 years. Market will continue to go up and down, and they will go in cycles. And we are also beginning to see a bigger problem in terms of the dollars, where the weakening of the dollar will continue to be more apparent as we go on. So these are the 5 areas where we can expect the impact on healthcare, on climate, on debt, market, as well as the dollars.
So let's go into more detail about the economy in 2021 onwards. And you can see in terms of the economic growth, of course, 2020 is not doing well because of the COVID-19 contract of 3.7%. And with the added stimulus that is coming soon, which we think will come soon, right? There will be a rebound of 4% growth rate in 2021. And after that, slow down in 2022, which is 3% over there, and 2.5% in 2023, right? And then when things are getting better, right, because of once the COVID-19 gets better, the vaccine is here, business is back to normal, and that is when inflation will start to kick in again, expecting a 1.2% now in 2020, and it will slowly increase, right, and to 2023, where the Fed target inflation rate is about 2%. So that's inflation for us. And then in terms of interest rate, FOMC announced that the benchmark, it's may be around the inflation, which is 2% over there, right? So to counter the inflation, and that will happen, till at least 2023, right? So currently at this moment, due to the COVID-19 situation, the Fed actually reduced the rate to around the range of 0 to 0.25% due to COVID-19.
So hopefully with the response to the COVID-19, the stimulus coming in can drive more business activities and hopefully will impact on employment as well. We can see that this is the graph from the BLS, which is the Bureau of Labor Statistics over here, which is the official department. And you can see that on average, the unemployment rate was at about 6% or 7% on average, okay? Although it comes in cycles. But look at the recent pandemic COVID period. It went all the way to almost about 15%. There's a huge number of job losses, as you can see. And you can see that a lot of job claim from the insurance as well. And looking at that, from the total of about 165 million of jobs, with a 15% reduction, about 25 million jobs were lost just during that 6-month period. And we can see some slight recovery over the recent months with more activities coming back, and that was pretty helpful. So what is expected is that during the next 10 years or so, the Bureau of Labor Statistics are expecting an increase of a mere 6 million jobs in the next 10 years or so. And that is not enough to to compensate the 25 million job losses. So we will continue to see these challenges, people losing their job and they're not getting their jobs back for the next, a good 10 years from now. So these challenges will be sustained and it will be impacting on many people's livelihood, business activities, and of course, the market overall globally as well.
Yeah. So talking about globally, let's take a look, and also see other than just US itself in terms of the GDP, right? So if you can see the graph here, the horizontal line is actually the real GDP growth, 2020 for forecast, and as well as the vertical line is actually talking about the growth acceleration and deceleration over there. So why not we just talk about the main two biggest economy, which is US and China. Of course, there are many other countries over there that is shown over there, but you can see that in terms of US itself, it's around 2%, which is what we had mentioned, expected, and with a growth deceleration, more towards slowing down the economy, probably because of COVID-19. There's a huge slowdown over there. But China is really doing well, right? China is about 5 to 6% kind of a growth rate. However, being too aggressive in such a big country, and also COVID-19, we expect that the growth should be still decelerating and moving down, in the near future, about maybe 4% or that kind of range over there. So everybody is affected by COVID-19, and in terms of GDP, in terms of interest rate, and also the Fed, right, movements, FOMC, what they are doing, the strategic movements, the policies, and all that affect most of the countries out there because most people are trading with US and also holding on to US dollars.
So in general, we can see that the red bubbles here are the Asian countries, and the Asian countries are of higher growth. Although we can see that most are coming to a deceleration, slowing down in the next years to come. So we hope that this session has been useful. And for more information, please follow us on this corehub.me World News. And we have many updates. You can scan this QR code and you can follow us on the Facebook as well. This is the QR code for the Facebook, and it is called the Modern Power Investor Options. Over here, we will give you all the latest updates on the market, and we hope you will continue to join us in the series.
Yes. All right. So thank you very much for watching this series, and of course, invest the smart, simple, safe way. All right. And then we'll see you on the next one.